Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right. What's up, guys? We are back with another episode of the Real Estate Investing Club. As always, Friday energy coming at you. This is going to be a little bit different of an episode. We are going to be going into the legal side of things. We usually are focused entirely on GPs, on operations, that kind of stuff, getting deals done. But the legal side is equally as important, getting that purchase agreement signed, setting up that PPM, all those different things that you need to do, getting your syndication up and what's the word I'm trying to say? Up and running? Is that the phrase I'm looking for? I don't know. Yeah. Getting your syndication done. How about that? That's what we're here to talk about on this episode. We got Nick McGrew with us from Polymath Legal. He invests in multifamily, so he is an investor, and he also is the legal side of the real estate equation. So it should be a good one. Nick, thanks for hopping on the show.
Yeah, thanks for having me. Happy to be here.
All right. I told you before we get on here, we always like starting with stories. We like to hear how people got to where they are. So why don't you, I know you went to UW, so that's part of your story, which is awesome. Yes. So tell me a little bit more. How'd you get started and how'd you get to where you are today?
Yeah. So went to UW for undergrad, and going there, I took a couple of pre-law classes and loved it. And so I knew I wanted to go to law school. And with law school, you just get a law degree. You can use it for criminal law or bankruptcy or family law or whatever. So you get a basic law degree. Your first year, all your classes are the same for every first year law student for the most part. But then your second and third years, you get to kind of choose your electives a bit more. And so while you get a general law degree, you can kind of focus on the areas that you like. And so I've just always been fascinated with buildings and structures and whatnot. And so I always knew I wanted to do something in real estate. And so when I got to law school, they teach you, law school kind of gears you towards litigation, fighting in court. That's what most people think about with lawyers. And so I liked the skill sets I was learning in law school, but I was like, I don't see myself fighting in court too much. I don't really like to do that. And then my second year, I took a class called Entrepreneurship in the Law, and it focused on lawyers advising businesses. I said, yes, this is the kind of stuff I wanted to do. And then through that same program, I took more real estate related legal classes as well. And so I said, yeah, this is the type of stuff I want to do. So, and that's what we do today. We help real estate investors lawfully raise capital so they can create generational wealth and also passive income.
Nice. I love it. And you mentioned you also invest in multifamily. How's that story been going?
Yeah, overall, well, as you know, we're in a bit of a tougher cycle in the market. Thankfully, my investments so far are doing well. But obviously, I have worked with a lot of clients, and unfortunately, some of theirs are not doing a lot. So definitely seeing a whole lot more capital calls or trying to restructure loans as compared to 3, 4, 5 years ago.
Yeah, absolutely. Capital calls is not something I haven't had to do it yet, but it's not something I want to do. That would not be a pretty conversation.
Yeah.
So, the legal side of things are always, it's always interesting. And so there's a lot of ways we can take this. You've mentioned you said lawfully raise capital. That's one topic I want to get into. Before we do that, I want to talk about getting sued. If you're in real estate, you're going to get sued. You're going to get sued. It's going to happen at some point. Hopefully you're in the right. You're the one that wins the case. We've been sued a couple times, but it was never our fault. And so we ended up winning all the cases, but it's not fun. So what is the most common lawsuit you see with real estate investors, with owners?
The big one, I would say, investors claiming that they were not informed of something. So not disclosed. If a deal goes bad, we want to point fingers. And, if a deal goes bad and my money's in it and I'm not getting all of it, it's not my fault. So I've got to blame somebody. And that's going to be you, the operator. And so that's why one thing that I always focus on is disclosures, because that's one thing that the SEC is going to look at a lot. That's one thing that they would look at in the lawsuit is I think my goal as the securities attorney is to make sure that obviously that you're raising the capital lawfully. But a big part is that scary PPM you kind of mentioned earlier on. And my big goal in that is to think of all the crazy bad things that could potentially happen and let the investor know. Because while the operator is going to try to make a lot of money, and a lot of them have made lots of money for their investors, all investments have risks. And so we want to make sure we're clearly disclosing those risks. And so I've had a few clients where there was the threat of lawsuits, and they say, "Oh, you didn't tell me this, or you didn't tell me that." And then the client comes to me and they're saying, "What should we do? What's going on?" I say, "Oh, just have them look at this page on the PPM." And sure enough, they look at it and it goes away. So my goal is to try to help you avoid those lawsuits, or if you do get sued, to make sure that all your documents are buttoned up so that you'll be in a good place to where you can prevail.
Interesting. I wasn't even thinking about that. We've been sued because like a limb fell or nicked somebody's trailer, and they sued us for the trailer damage. And we were like, we maintain these trees. We have an arborist come out every year. And so it was just an act of nature. But you're talking about being sued because you're not like your LP's suing you because you're not meeting goals, essentially. And so I did not know that you had to disclose absolutely everything. I thought that for syndications, because they're entering into this contract knowing it's a risky endeavor. So that does not cover the GP, is what you're saying. Like, you have to state that the economy could turn, the whatever, like
we still have
anything that can go wrong can go wrong.
We have warnings about COVID, a couple, maybe a year ago when they were talking about bird flu, we threw that one in. We have warnings about global warming. And it's not so much that you legally, absolutely, if you don't have every disclosure, then you're criminally have a criminal violation. There are certain disclosures that the SEC is just going to require, especially risks that that if you were an investor, you'd want to know about. You got to disclose that. But we try to disclose just all of the potential bad things, because no deal's perfect. And one of the things that we do when we're working with a client that's an operator, one of the questions that we ask them is, I say, what are the things that are keeping you up at night? What are the things that you're scared about? And there's always going to be some, and that's okay. That's the nature of this industry. But I ask that question so I can understand, okay, what are the risks that they're like, oh my goodness, if this happens, what's going to go wrong? What's going to happen? Yeah. We want to let the investor know that so that they can evaluate whether they want to take that risk on themselves or not as well. And if they don't, you're like, oh man, that's money I'm missing out on, which, that stinks. But I tell my clients, I say, we want these documents to scare the investors away now. We don't want to kind of put something under the rug or be a little quiet about it, get them to invest. And then if that worst case scenario unfortunately happens, now you have their money and you're losing their money and they were not informed about it. If anything, I say, listen, we want to tell them those scary things. And if that scares them away and they don't invest, that stinks, but that's good, because the document did what it's supposed to do. It's there to inform the investors, to let them evaluate, do I want to take this risk on or not? And so you want to give them the information to where they can give that full evaluation.
Yeah. So generally, like if I'm raising money, the thing that I'm always the most afraid of are the things that are completely out of my control. Like if for some reason this local economy, maybe a big employer up and decides to leave the area, hundreds of people, lose their jobs, the economy tanks, that kind of thing. That's the thing that kind of keeps me up at night, but I know I have no control over it. Is the GP, if you don't disclose that, are you still liable for not having disclosed it? And let's say you're in a city, it's 100,000 people, the biggest employer in that town leaves, and now your vacancies are through the roof. What are you liable for not having disclosed the possibility of the economy tanking or whatnot?
I'm going to give you the lawyer's favorite answer, which is it depends. So we'd have to know all the ins and outs of what's going on there, but there's definitely potential. I do have some clients. Well, they'll invest in a market that has maybe 3 big employers. And so we absolutely disclose that. And, it's not so much that it's your fault that they laid people off or moved or what have you. But as an operator, you should be kind of knowing, or at least have an idea about these things. What are my weaknesses in this deal? And so things like that are weaknesses that, they're out of your control, but it is something that can affect your bottom line. And so especially if you're aware of that and know that type of stuff, then we want to make sure we're disclosing that. So the investors can say, that's a little too risky for me. Let me know about the next deal in the next market, versus you not disclosing it. And now there's a risk that they would have scared them away that they weren't informed about.
Interesting. Okay. That makes sense. So yeah, syndications, that is the leap that every investor gets to once they realize that they can't use their own capital anymore. Like, you're all going to get there. You're going to get to big deals that are too big for your bank account. Like, you're going to have already spent your money and now you need to raise capital. So it has to happen. Syndications is the solution to that. But there are a lot of ways to go about doing it. Take the perspective of a new syndicator, somebody who is just coming to the scene. Maybe they've bought, a couple quads, some single family, maybe a self-storage. They bought it with their own money, but they want to do bigger deals. They want to do 1,000 to 500 unit multifamily complex. What are the steps that you would take them through to set up their syndication?
Yeah, so the first thing, if you're new, the first thing I would explain why you're going to hire somebody like me and have to pay a lot of money. And that's basically because you're selling a security. And so the law says basically if you have an investment of money in a common enterprise with an expectation of profit, primarily from the work of someone else. So a way to summarize that, if you're taking passive capital, so if somebody's writing you a check and they're just expecting bigger checks back, then it's likely that you're selling a security. And so the law says you either have to register that security, so go public essentially, or have an exemption from registration. And so we help clients with the exemptions because one, going public is very expensive. And if we're talking about your standard real estate deal, just the timeline's just not going to work. It takes quite a bit of time. And so you're selling an exempt security. And so we make sure you understand what that is. And then probably the next thing I'd ask is I'd say, what do you think your investors look like financially? And mainly what I'm trying to get at is, are they accredited or sophisticated? For those who don't know, two of the main ways you become accredited as an individual is either through income or net worth. And so if you're an individual, if you have an income of $200,000 or more, and you've had that for the past 2 years, and you expect to have that or more this year, then we say you're accredited. So you make $200,000 as an individual, you're accredited. Or if we're talking about spouses, then we up that number to $300,000. So if you're talking about it by income wise, individuals is $200,000, spouses is $300,000. If you meet those numbers, you're accredited. Another way is by your net worth. And so there, whether you have a spouse or you're an individual, if you have a net worth of $1 million or more, excluding your primary residence, then you're accredited as well. And so we try to figure out, okay, do you think most of your investors are accredited or are they something else? Because that helps us understand which exemptions apply. The most common exemption that I use for real estate is Regulation D. And so within that, there's one exemption that allows you to advertise, but 100% of your investors must be accredited, so that high net worth or high income. There's another exemption that doesn't allow advertisement, but you can get up to 35 people who are not accredited, and they can invest as long as you have a pre-existing substantial relationship with them. In addition to that, you can get an unlimited number of accredited investors, but again, you have to have that pre-existing substantial relationship with them. And so sometimes people say, oh, well, I want my friends and family and my cousins, and some of them are accredited, but not all of them are. Then we might say, hey, 506B might work for you. Whereas some people say the majority of them are accredited, but I have a big raise and I want to be able to advertise. Then we say, okay, 506C is probably going to be a better one for you. But yeah, we talk through that and see which exemptions apply, and then ultimately which exemption is going to help you meet your goals the best.
Yep. And so let's say they decide on 506C, they need to make sure that these people are accredited. Does it land on the shoulder of the GP to verify their net worth or their annual income, or where does the liability fall there?
So yeah, the responsibility is ultimately on the operator or the GP, but I tell my clients that they should not be the ones verifying. So if we are doing 506C, which is accredited investors only, the SEC says that self-certification alone is not enough. So the person can't just say, I'm accredited, and you say, good, we're good to go. We've got to have a third party verify, or you, the operator, need to take their tax returns or look at all their balance sheet and whatnot. And so I always recommend for my clients to have a third party do it because one, that takes a little bit of the liability away from our client, because if they're saying, oh yeah, I looked at the tax return and I looked at this, and if they miss something, now that's their fault. Whereas if you have a third party verify, the SEC says you have to take reasonable steps to verify their status. And so if you have a CPA or there's companies that do it and they're giving you a letter that says, yeah, they're verified, I looked at their stuff, now I'd say you've taken reasonable steps.
Yeah. That, by the way, that space, I feel like there's a lot of opportunity for now that AI is really big, and you can build an app in like 2 seconds. I don't know how many websites I built in the past like month just using AI. But the tools out there for investors to basically, it's like a CRM for the syndication process, and you get all the documents and everything. They are thousands of dollars on market right now. This is a total aside, but if any of you guys out there are interested in AI, you should figure out a way to make that app and then just do it for a quarter of the price, and you'll be making money. Anyways, on that topic, actually, and this is another aside, I am curious. Legal review is something, in real estate, I look at a shit ton of docs, legal docs, and we've been using AI more and more, specifically Perplexity we use a lot. Have you been seeing that take an effect in the legal field, or how do you see kind of AI having an effect on syndication specifically?
I will say the legal industry as a whole is very slow to move. We're a very slow industry. It's trying. There are a good amount of AI based apps and whatnot out there. They're not as right now anyway, not as helpful as I would have thought that they would be. Even like one of the main legal information databases is Westlaw, and so they have a new AI component to their stuff. And we have the subscription, and it's helpful. It's not as groundbreaking as I would have thought it would be. I definitely see that there's a lot of opportunity there, particularly in the legal space. Because, when AI started getting really big a couple years ago, I said, once Westlaw uses this, because Westlaw has good legal information and their data is going to be very good. I said, once they get it, it's going to be amazing. And it still leaves a bit wanting. It's definitely, there are things that are helpful, but it's not quite as groundbreaking as I would have hoped for. But again, yeah. I'll say again, law is also slow to adopt most things. So we're probably a little bit behind as well.
Yeah. Yeah. I mean, I've been impressed with how, you can tell it to make any document. And they make fairly decent legal docs now. I've always been I like AI, and I've been impressed with what it's been able to do. Anyways, back to the topic. So 506C is that the one that you generally recommend people start with? I know there's two different camps, but it sounds like 506C, especially if you're wanting to look outside of friends and family, that's the one that you would generally push people towards.
Yeah, I kind of tell people, number one, look at your network and look at how much you need to raise. Some people will say, yeah, I can raise, if I'm raising like $1 million or $2 million, I might have that in my network. In which case I might say we can do a 506B, so that way the people in your network that are not accredited can invest, and also the people that are accredited can also invest. One thing I will say, and that I do tell clients, a lot of times for your first deal or so, it's going to be less likely for you to get a random person that you don't know already. So oftentimes people's first deals might be 506B, where you're having your friends and family and people you have a relationship invest.
But even then, do you even want someone who's not on the credit, who doesn't have at least a minimum, $1 million in net worth? Do you even want them to invest in your deal? Because if they don't have that much money to their name, then it's a bit, every investment is a risk. And so you're asking somebody who doesn't have a lot of money to put their money into something that does have risk. It doesn't matter how good you are at real estate, it does have risk. And so I don't know. I've always been kind of wary of just, why would you want 506B? It just doesn't make sense to me.
So I will definitely say, and I've told this to clients, you don't want to take somebody's last dollar. So you do not want them to invest that, because it is risky. And hopefully, again, if they are and not that 506B is limited to friends and family, but a lot of times that's who it's going to be. Hopefully, if they are your friends and family, you are looking out for them and you have an idea of their financial status and have enough to say, hey, are you sure about this? This is a lot. Maybe we should lower or something like that. Because you definitely do not want to be taking their last dollar. But there are people that maybe they're high income or just not quite accredited yet. Maybe you just got that tech job and you're making 300, but you've only worked there for a year and a half. So technically you're not accredited yet, but it's not as risky for you because you see the growth pattern. So there are ways to where you're not, taking advantage of people, or it's not quite that risky. And then also too, depending on just how your finances are set up, some people, I've had some clients where there's trusts or other things involved that are not solely owned by the person, so it can't be computed for their sole net worth, but they still have, backups if things really went bad. So yeah, I get your point and I agree with it. We definitely don't want to take advantage of people or put people in a bad situation, because it's hard enough if you're the operator having that conversation with your wealthy investors saying, hey, I lost your money. It's going to be dramatically harder for somebody who's not super wealthy at telling them that you lost their money.
Yeah, well, and I wasn't even thinking of taking advantage or putting people's money at risk. I was just thinking, the minimum that I would ever want somebody to put into a deal is $50,000. I don't want somebody to put in $10,000, and if they're not accredited, chances are they don't have $50,000 to put in. So, anyways, that's kind of, I guess it's a personal preference there. But with 506C, I mean, the advantage is you can start marketing. You can just put it out there and say, hey, we got this deal. If you want to invest in this deal, fill out this form, reach out to me in email, whatever it is. And you can start having those conversations. You don't have to have that pre-existing relationship, which is nice.
Yeah, correct.
Awesome, man. Well, hey, it looks like we have run down the clock. It's already 20 minutes. So it's time to jump into the quick question round. Are you ready?
Let's do it.
Let's do it. Starts with education. It could be any form. It could be a movie you've seen, a book you've read, a conference you've gone to, mentorship program you've been a part of, anything like that. I just need 2 recommendations, one for general life wisdom and then one for real estate or business. Hey guys, quick break from the show. If you've listened to this podcast before, you know we are always talking about how important it is to have the right mentors and partners in real estate, which is exactly why I've opened up the Real Estate Investing Club online community. It's a place for active investors to learn, collaborate, and get real deals done together. And right now, it is 100% free to join. We host weekly calls where we review deals, talk strategy, and share tactics. Just click the link in the description below and come join us.
For education wise, for real estate wise, I actually, a couple years ago, I took a real estate development course as a executive certificate at USC. It was amazing. It kind of takes you through the whole development timeline in about 6 weeks. So definitely it's a crash course. But I took it not so much that I'm looking to be a developer myself, but I have some developer clients. And so I want to understand more of what they're working with. And so it goes everywhere from site location to financing, to the actual construction, the permitting, all that sort of stuff. And so that was an amazing, especially for real estate, and particularly if you're looking to get into development, amazing program that, I highly recommend that one for sure.
Nice. That's you're the first person to say like an actual university course or whatever. But that's a good
and what
call.
I'll say is it's cheaper than a lot of the courses and masterminds that you find out there as well. So
oh yeah, for sure. Those guys, those are getting up to like 25,000 now. It's crazy. How much was that certificate that you went through?
I did it about 5 years ago. I think it was like $5,000 or $6,000.
Yeah. Okay.
So they may have increased it a little bit, but probably not dramatically from there.
Interesting. Huh. Cool. So how about that was real estate? How about general life wisdom?
At least a book that I really liked. It's probably, now that I've read more self-development and self-help books, it's similar to all of them, but Limitless by Jim Quick. A great self-development book. He had a brain injury when he was younger, so it's hard for him to learn. And so he just really learned a whole lot about your brain and how it tricks you and whatnot. And so he shares a lot of those tips. So yeah, that's a great book that I often recommend.
Nice. Yeah, that sounds like it would be right up my alley. All right. With that, I'm going to move us on to the next one. This is for your younger self. So let's go back to the Nick, who is still a Husky, still out there at UW. Go back to him, look him in the eye, give him one piece of advice moving forward.
Just keep on going. The journey is going to look very different than what you plan, but just keep moving forward step by step every day, and you will get there eventually.
Yeah, it is not a straight line. That's for sure. It is up, it's down, it's left, it's right. Yep. Just keep going. All right. Next question is about the U.S. It's a big place. There is a ton of opportunity out there. Give me the single metro you're most excited about investing in today.
Single metro. Ooh, that's a tough one. It's not a cheap market, but I like Seattle. I like, especially and particularly Tacoma. I have a couple of friends and people that I invest with there that are doing a lot of stuff. A lot of
Nice.
opportunity. Granted, I'm a little biased because that's the hometown, even though I haven't lived there for about 20 years, but still love it. And I think part of it's just because I know the area, I know the people, I know the companies, and I feel very comfortable. But also, even though it's a bit of one of the pricier markets, there's still a lot of opportunity and a lot of stuff going on.
That's funny. I actually live in Tacoma and I don't invest here. Tacoma, I mean, it is a great market. I just, for mobile home parks, RV parks, self-storage facilities, it's not the best. There's not great deals out here. And so I tend to look elsewhere, but, I should, I used to flip houses. That's actually how I got into real estate, was 2014, flipping houses and doing wholesales. I've been doing commercial since 2020, and I've been 100% commercial, but I should get back into the flipping houses scene. That it was a lot of fun back in the day.
Yeah, Tacoma's looking for houses. So I have a development company I invest with, and they'll buy a single family lot and they're able to build 11 units on that. And it's a pretty amazing project. And then they had one where they basically were able to build 22 units on it. So pretty fun stuff.
That's funny. There's actually the house we just moved into a house, new house up here on Proctor. And it was, anyways, it was a good deal. We got the house, but it's right next to a lot that is completely vacant. And I just found the owner recently, and I called him because I was like, hey man, I want to buy your lot. And I had this price in mind, and he gave me a price of $3.2 million. I was like, I was about to offer him. He had bought it for $300,000 a little while ago, and I was going to offer him, I was going to double his money, like $600,000. And he gave me that price. I was like, you are out of your mind. He said, hey, that's what a developer will look at it. They'll, and that, that price makes sense. So I said, all right, that doesn't make sense for me, but all right. All right. Anyways, that leads us to the next question. This is about lessons learned. Not every deal we get into goes the way we expect it. In fact, many times things go wrong, and that's when we get to learn a lesson. So what is one deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
We were kind of talking before, and I was telling you how I had some Airbnbs and invested in them, and they did not do very well. There was a lot of work. So I think the big thing I learned from that is, one, stay in your lane. I was just I had some extra cash and had a friend that was like, hey, let's do this. And I just didn't didn't vet it and learn that industry as well as I should have. And so there was just a lot of, it just didn't work. And I know that obviously there lots of people can make Airbnb work very well. But it just was a lot more headache than it was worth for me. And so the big thing I learned from that is, one, do a little bit more homework, and probably more importantly is stay in my own lane, do the stuff that I know. For if it's stuff that I don't know, just give cash to the expert and let them ride with it. But for the stuff that I'm doing, stay in my lane, stay with the things that I know, and vet it a little bit more. Which is odd, I know, coming from the lawyer. But
No, and that's really good advice. I have horrible shiny object syndrome, and every time I hear about a new strategy, I'm just like, oh, I want to do it, but every single asset type, every single strategy that you get into in real estate is a different model. You do have to learn it. Short-term rentals are great. There's guys out there crushing it, but you have to learn how to do short-term rentals versus self-storage versus mobile home parks versus industrial, whatever. They all have their own nuances, and it's a new thing you got to learn. So if you're not, every time you make that switch, you're starting from scratch almost, not really, but you got to really learn it in order to get the best return from it. So staying in your lane is very, very good advice, and it's very hard, at least for me, to follow. All right, and that leads us to the last question. This is for the listeners. Actually, I'm going to do one more before this. We've already talked about raising capital. This is something that you help investors with. And so I'm sure you've seen a lot of ways to do it. So what is either your favorite way or the most effective way that you found for people to raise capital?
Yeah, I think my favorite way, for just all things being even, I like Regulation D 506C. The reasons why you can raise an unlimited amount of capital from an unlimited number of investors. Your compliance requirements are internal, meaning there's things that you're supposed to do in order to raise that, but you don't have to send it off to the SEC and have them approve it or vet it or anything. The only way the SEC is going to come into play is if there's a complaint or an issue, and then you just have to say, here's my documents, here's my compliance. So it's quick, it's streamlined. You have basically no raise limits. And so this is not regular, but we've set a client up, I think in like 8 days or something. They were in like a major rush and they were on top of it. And so from when they reached out to us to when we had it ready for them to raise capital, it's like 8 days. And so you can, and again, that's not the normal. Usually it's about a month, but you can get that set up very, very quickly. And so there's lots of flexibility, lots of speed. So Regulation D, 506C, obviously you got to know what your situation is and whatnot, but if everything equal, that's the one that I like.
There you go. All right. And that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out and get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, so you can find me on social media. My name is @NickTheLawyer on Instagram, TikTok, all those. Or you can also come to our firm website, Polymath Legal. So that's POLYMATHLEGAL.com. If you go there, you click contact us, you can message us directly. You can schedule a free 15-minute discovery call to where we can talk about what your legal needs are. It also has our phone number there as well.
All right. I will put that link in the show notes. So if y'all want to reach out to Nick, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man. That wraps it up. Thank you very much for hopping on the show.
Thanks for having me.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review, a comment, or whatever you want to do. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.